I was talking on my recent Resistance Radio broadcast about debt-free money and ending the fractional reserve banking system. And I think it would be useful to point you in the direction of some people that are actively trying to do those two things in Britain. But first, it's worth giving a brief recap of how the current system works and why it needs to be changed. A common idea that the alternative media talk about is that money is printed out of thin air as debt. That is of course true, but it's a little more complex. Money is rarely printed anymore. It's simply numbers on a computer screen. So when people are saying, oh, they're just printing money out of thin air, just be sure to understand that there isn't actually any printing at the mint or the central banks going on, and the printing of physical money is an entirely different aspect of the banking system. In fact, the central bank printing physical coins and notes and selling it at face value to the private financial system as a way of raising government finance is a tried and tested form of debt-free money. Unfortunately, it only makes up about 3% of the system. The rest of the quote-unquote money is numbers on a computer screen, debt in the form of loans.
If we go back to 1948 in Britain, almost half the money in circulation, half the money stock was publicly created debt-free money, because half the money in circulation was notes and coins. Now, when the government creates notes and coins, what it essentially does is it prints it and sells it to the banking system, which buy them at face value, and the money which the government receives is simply credited to the Treasury as an effective debt-free input. So, in 1948, just after the war, half the money in circulation in Britain was publicly created debt-free money. Today, it's about 3%, simply because people use notes and coins less, and because electronic transfers have increased.
When our government needs to raise finance for illegal wars, to pay the European Union, or to fund public services that go beyond our tax money, they don't go to the Bank of England and print the money into existence debt-free. They are forced to borrow it from private bankers and must pay it back with interest, just like we would on any normal loan. Of course, the debt is then passed on to us anyway in the form of the yearly deficit and the overall national debt, which is now pushing £4.8 trillion. Let's look at an example. So the government needs 500 million to invade another Middle Eastern country, let's say Iran. They go to the Treasury, and the Treasury issues 500 million in government bonds or gilts, better described as IOUs. Overseas investors, insurance companies and private bankers purchase these IOUs, and now the government, or more accurately the people, are 500 million more in debt. We have to pay this sum back with interest. Currently, we can only afford to make repayments if we sell even more bonds to private institutions. In other words, we are stuck on a never-ending fishing line of credit and debt. And of course, it doesn't help when we bail out the private bankers when they get too greedy and fail. So the concept of creating debt-free money is to nullify this exponential national debt that we owe to the private financial system by eliminating the need for the government to borrow money. Instead, it can create its own. The Bromsgrove Group is actively pushing for this in the UK.
Publicly created money is money created by the government of the day, debt-free. That is money which does not have to be paid back. That's our main policy focus. Debt-free money, not borrowed money, not interest-free money, which is another thing, not low-interest money, but debt-free money. Publicly created money, money created by the government debt-free. As you know at present, the government borrows money from the banking system, the private banking system, which has the power to create it out of nothing. And then the government asks us to pay that money back in our taxes. Well, what we're saying, and what money reformers in the United Kingdom are concentrating on, is that the government has the power, indeed it has the duty and the responsibility to create a supply of money, debt-free, and spend it, not lend it, into society, instead of running to the banking system for it. And that essentially is the message that we promote and that we take out and that we try to sell to economists, to journalists, to political party activists. And we call this money publicly created money, since it's created on behalf of the people of the nation by their elected government. It belongs to the people of the nation, and it works to benefit the people of the nation. And it's not intended to benefit the banking system or any private interests, as so much government borrowing does at present. And we refer to it as publicly created money, again, to avoid terminology like government-created money or state-created money, which again can provoke knee-jerk responses. Government-created money? Well, you don't want the government-created money. That's usually the first knee-jerk we get to that. So we drop government-created, drop state-created, publicly created money, because that's what it is. Money created for the people by the public authority, the government. And what's especially good about it is there's a precedent for this in the United Kingdom and also in Canada as well. If we go back to 1948 in Britain, almost half the money in circulation, half the money stock, was publicly created debt-free money, because half the money in circulation was notes and coins. Now, when the government creates notes and coins, what it essentially does is it prints it and sells it to the banking system, which buy them at face value, and the money which the government receives is simply credited to the Treasury as an effective debt-free input. So, in 1948, just after the war, half the money in circulation in Britain was publicly created debt-free money. Today, it's about 3%, simply because people use notes and coins less, and because electronic transfers have increased. Well, what we simply say is if the people could get the benefit of a 50% debt-free money stock in 1948, then there's no reason why they can't get the benefit of a 50% debt-free money stock today. Not necessarily through the mechanism of notes and coins, but through an electronic mechanism, for example. And I want to emphasize that we're not, in that particular reform, addressing the ability of the private banks to create money out of nothing. We're talking about money being created in the public sector, not the private sector. Money creation in the private sector is a different matter. We here are addressing the responsibility of the state, the government, to create debt-free money for public needs. Depriving the banks of their ability to create money out of nothing and to enjoy the profit of so doing is an important issue for some people, but it is a slightly more complex matter, which goes beyond publicly created debt-free money, which we emphasise. I mean, some reformers in Britain are saying that banks should only be allowed to lend out money which already exists and has been created by the state. For example, James Robertson and Joseph Huber published this book, Creating New Money, about 4 years ago. James Robertson and John Bunzel have produced another little booklet, a copy might be at the back, addressing that issue, addressing the ability of banks to create money out of nothing, the private banks. But it is a different issue from what the mainstream, the main money reform movement in Britain addresses, which is simply publicly created debt-free money. To the extent that we draw attention to the fact that private banks create money out of nothing, we do so simply to assert this essential first principle. If the private banks can create money out of nothing, then so too can and should the government of the day on behalf of we, the people. And further, since the banks create it out of nothing and lend it to us, the state can and should create it out of nothing and give it to us. Establishing that first principle in practice, having the state creating and issuing debt-free money, is what we believe a workable and attainable first step. It's a reasonable proposition. It's not revolutionary. It's got a precedent. And our opponents find it hard to argue against. And once that reform is up and running, then it could provide a working model which may lead to further changes in time. You could look at it this way. At the moment, the banking system has a virtual monopoly on the creation of money, the private banking system. And our reform, publicly created debt-free money, will simply introduce an element of competition into that arena. So what's the technical way to establish that reform in reality? Well, we've addressed that in Prosperity. We regularly address it. I don't need to address it now, although we've addressed it in the August 2002 issue. I think there's copies at the back. And here it could be done, no doubt, through the Bank of Canada. So how are we promoting that message in Britain, and how successful have we been in it? Ideally, of course, what's needed is a bill to be placed before Parliament which lays this out, which is voted on and which is passed into law. But we're not there yet. Before that time comes, what we need to do is to spread awareness of our ideas in the Parliament. We need to educate members of Parliament, and we need to create enthusiasm for the idea. And one of the ways that we're doing this at present is to take advantage of a parliamentary device which is called an early day motion, or an EDM. Now, an EDM is the term used to describe motions which are tabled by members of Parliament that are not expected to be debated. Effectively, the tabling of an EDM in Parliament by an MP is simply a device to draw attention to a particular issue and to elicit support for it by the means of inviting other members of Parliament to add their signatures. An early day motion in EDM is current for one parliamentary session, which is for 12 months, and the aim of any campaigner is to get a majority of the members of Parliament to sign it, because that would signal significant support for the proposal. Now, for the last 3 years, what we've been doing, what the Bromsgrove Group has been doing, is been getting together and drafting an EDM, giving it to one of our sympathetic members of Parliament who sponsors it, who tables it, and who tries to solicit support from other members of Parliament. And for the last 3 years, the members of Parliament signing each year's EDM has been increasing. For example, I just want to read you this year's motion, which was tabled on the 17th of December by Austin Mitchell, Member of Parliament. That this House notes with concern the contrast between the enormous expansion of private credit and the growing debt burden that this imposes on society. Further notes that public money, as measured by the proportion of publicly created money in circulation, has fallen from 20% of the money supply in 1964, which was 20% of the money supply was notes and coins, to 3% today, and believes that using public money and increasing the proportion of publicly created money should be used to cut the costs of and boost the quantity of public investment. Further believes that this can be done without any impact on inflation, and therefore urges the Treasury to commission an independent review of the benefits of using public money and increasing the proportion of it in society. So there is a precise money reform message circulating from the Bromsgrove Group in Parliament and getting support of members of Parliament. Now, how many members of Parliament support this idea? Well, there's 660 members of Parliament, and at the moment we have 33 members of Parliament who are prepared to put their name to that and are prepared to stand by the Bromsgrove Group and what we're saying, which works out at exactly 5% of the members of Parliament. Now, that's not much, but it's 5% more than we had 3 years ago. And in 3 years' time, we'll be over 10%. But that's really not the way to look at it. What's going to happen is that when this catches on, which it will within the next 10 years, it's going to spread very, very quickly. And we do have to admire these MPs who have stuck their necks out and committed their names to these money reform motions, because generally speaking, most politicians can't be expected to stick out their necks and advocate a policy if they feel there's not enough significant mainstream backing for it, say among the journalists, among the economists, among the academics. So the 5%ers in Parliament who have actually stood by that money reform motion are really to be congratulated. I'd suggest to you that we're in a position, certainly in the United Kingdom, where we're on the cusp of a breakthrough, but most politicians are not yet generally willing to step forward until they feel there's more support for this. And that support is going to have to come in the academic community, in the economic community. But I do see it coming. I mean, we've got one or two ideas in the Bromsgrove Group to promote publicly created debt-free money within the academic community. What we're hoping to do is to put together a syllabus on monetary science, which we don't believe exists at the moment anywhere in any university, anywhere in Britain. We're going to try to put that together, try to get that circulating among the economists and so on, and just generally create a trend to promote these ideas. What do we say when people say that's inflationary? Well, what we initially did was, this is our canned response in our January 2004 issue, Publicly Created Money and Inflation, and I think there's some copies of this January 2004 issue at the back. There's several things really that we should point out, but first what we say is we have to establish the essential principle. We're not going to get diverted into arguing about the inflation thing. We're simply going to be saying that the essential principle which needs to be established is that the government can issue a security, which is in effect an IOU written by the government to the banks. Then it can issue the same amount of money directly and debt-free without borrowing from the banks. As Thomas Edison said, if the government can issue a dollar bond, it can issue a dollar bill. That's the essential principle. And if the government or academics come to us and start arguing about, oh, it's going to be inflationary, whatever, we're saying, well, we're concentrating on the principle. And further, as monetary reformers, currency stability is at the heart of our agenda. So how dare anybody say to us, oh, you're trying to debase the currency with this idea? Not at all. Monetary reformers believe in currency stability. One of our organisations, the Forum for Stable Currencies, that's what it's all about. So we're not going to promote something that is going to destabilise the currency. Furthermore, what can lead to inflation is societal breakdown. And you're going to get societal breakdown if you don't have publicly created money, if you don't have the sewers and the bus services and the railways and the hospitals running on time. You're going to get societal breakdown, which is going to lead to inflation. So our publicly created money alternative is in fact going to be anti-inflationary. And at the end of the day, it's not who creates the money, it's not whether the government or the banks create the money, it's about how much is created, which can lead to inflation. And of course we're saying that the amount of money created is going to have to be a measured amount. We're not going to flood society, or else you would debase the currency. And there's no incentive. What we're saying to the government, there's no incentive, for a government to spend to create too much money, because if a government created too much money, it would overspend, it would cause inflation. So there's no incentive for any government which has this tool of publicly created money to actually to overspend. There's no incentive. If a government minister suggests that possibility, then he's condemning his own government out of his own mouth, because he's suggesting that his own government, if given this tool, would be incapable of running the economy properly. So we don't put ourselves on the defensive, and it's the apologists for the status quo that we should be putting on the defensive.
The next step to free ourselves from debt slavery would be to outlaw the practice of fractional reserve banking, which accounts for over 90% of the money in the UK. All just digits on a screen. As illogical and corrupt as it sounds, commercial banks can lend money in the form of loans, mortgages and other credit that they don't even have. They only have to keep a fraction of deposits and other assets in reserve. Douglas Carswell is the only British MP trying to expose this scam of creating money and profit out of nothing.
Mr. Speaker, I beg to move that leave be given to bring a bill to prohibit banks and building societies lending on the basis of demand deposits without the permission of the account holder. Who owns the money in your bank account? This small question has profound implications. According to a survey by Ipso Mori, over 70% of people in the UK believe that when they deposit money with the bank, it is theirs, but it is not. Money deposited in a bank account is, as established under case law going back over 200 years, legally property of banks rather than account holders. Were any honourable members this afternoon to deposit £100 at their bank, or rather improbably, if IPSA were to manage to do so on any member's account, the bank would then be free to lend on approximately £97 of that £100. Even with the new capital ratio requirements coming in, the bank could lend on over 90% of what you deposit. Indeed, Bank A could then lend on £97 of the initial £100 deposit to another bank, Bank B, who could then lend on 97% of the value. Round and round the lending would go until, as we saw at the height of the credit boom, for every £1 deposited, banks had piled up over £40 worth of accumulated credit of one form or another. Banks, in other words, Mr. Speaker, today enjoy a form of legal privilege that extends to no other area of business that I'm aware of. And it is a form of legal privilege. I'm sure that some honourable members, in full compliance with IPSA rules, I'm certain, may have rented a flat. I'm sure that honourable members don't need me, or indeed IPSA, to explain that having rented a flat, it is not generally allowed to then sublet that flat onto someone else. Try doing that and your landlord would most likely eject you. So why then are banks allowed to sublet your money many times over without your consent? My bill would give account holders legal ownership of their deposits unless they indicated otherwise when opening the account. There would, in other words, henceforth be two categories of bank account: deposit-taking accounts for investment purposes and deposit-taking accounts for storage purposes. Banks would remain at liberty to lend on money deposited in the investment accounts, but not the storage accounts. As such, this idea is not a million miles away from the idea of 100% gilt-backed storage accounts proposed by other honourable members and by the Governor of the Bank of England. My bill is not just a consumer protection measure, however. It also aims to remove a curious legal exemption for banks, which has profound implications across the whole economy. Precisely because they are able to treat your deposit as an investment in a giant credit pyramid, banks are able to conjure up credit. In most industries, when demand for something rises, businesses in that sector produce more of it in response. The legal privilege extended to banks prevents that basic market mechanism from working, with disastrous consequences. As I shall explain, if the market mechanism worked as it should, once demand for credit started to increase in an economy, banks would raise the price of credit, interest rates, in order to encourage more saving. More folk would save as a result, as rates rose. That would allow banks to extend credit in proportion to savings. Were they like any other business, When demand for what they supply lets rip, banks would be constrained in their ability to supply credit by the pricing mechanism. Not so, alas, with our system of fractional reserve banking. Able to treat your money as their own, banks can carry on lending against it without necessarily raising the price of credit. The pricing mechanism does not rein in the growth in credit as it should. Unrestrained by this pricing mechanism, we therefore get credit bubbles. To satisfy runaway demand for credit, banks produce great candy floss piles of the stuff. The sugar rush feels great for a while, but that sugar rush credit creates an expansion in capacity in the economy that is not backed by real savings. It is not justified in terms of someone else's deferred consumption, so the credit boom creates unsustainable overconsumption. Policymakers, not least in this chamber, regardless of who has been in office, have then had to face the unenviable choice between letting the edifice of crony capitalism come crashing down with calamitous consequences for the rest of us, or printing off more real money to shore up this Ponzi scheme and the people who built it, and in doing so devalue our currency to keep the pyramid afloat. Since the credit crunch hit us, an endless succession of economists, most of whom I note didn't see the crunch coming, have popped up on our TV screens to explain its causes with great authority. Most have tended to see the lack of credit as the problem, rather than as a symptom. Perhaps instead we should now begin to listen to those economists who saw the credit glut that preceded the crash as the problem. The Cobden Centre, the von Mises Institute, Herta de Soto, they all grasped that it was the overproduction of bogus candy floss credit before the crunch that gave rise to the credit crunch. It's time to take seriously their ideas on honest money and sound banking. Now, the Keynesian monetarist economists might recoil in horror at the idea. Their orthodoxy holds that without these legal privileges for banks, there would be insufficient credit. The oil that keeps the engine of capitalism working, they say, would dry up. The machine would grind to a halt. Not so. Under my bill, credit would still exist, but it would be credit backed by savings. In other words, it would be credit that could fuel an expansion in economic capacity that was consummate with savings or deferred consumption. It would be, to use the cliché of our day, sustainable. Ministers have spoken of their lofty ambition to rebalance the economy, from one based on consumption to one founded on producing things. A good place to begin might be to allow a law that permits storage bank accounts, which do not permit banks to mass produce phony credit in a way that ultimately favours consumers and debtors over those who create wealth. With honest money, instead of being a nation of indebted consumers that we have become, Britons might become again the producers and savers that we once were. With a choice between the new storage accounts and investment accounts, no longer would private individuals find themselves co-opted as unwilling, indeed unaware, investors in madcap deals in credit instruments few of the bank's own boards seem to even understand.
Both solutions given by the Bromsgrove Group and MP Douglas Carswell might not be perfect, but it's a step in the right direction and shows that there are true progressives that can look beyond the debt-based system that has enslaved the masses and empowered the moneyed elite.